posting grades right now. Okay, grades have been posted. And I'll now download back up the grade book. And then, of course, we go to the quiz itself and enable you to see the correct answers. Okay, I believe all has been accomplished. Hold on. Yep, we are good to go. So let's do this now. Let me go to the first quiz that we took this morning. That's the one on equity. And I will run down the answers. So one is common, one stock is preferred. Which one receives dividends first? That's the preferred one. And that's actually the only real difference between common stock and preferred stock. The only real difference is preferred stock is preferred in regards to dividends. Second question, what someone spends to prepare a share of stock for sale is actually not relevant. What's relevant is if someone sells stock and gets $3, increase or debit cash for 3. They also want to increase or credit capital for 3, but you divide the $3 increase in capital between its par value, credit common stock, which is its registered value of 2, and its additional paid in capital, which is also equity value for the remaining 1. And so what I've just done is answer the next 2 questions. The par value is 2. The increase in cash or debit is 3. The increase in stock is the par value or credit of 2, and the remaining increase in value is paid in capital, credit of 1. Other comprehensive income is basically weird and unusual income items. And so the only thing I've listed here that is not weird or unusual at all is earning revenue when you sell a product or a service, which every company is in the business of doing. Treasury stock is when you repurchase your own stock, and therefore it is a contra stock account. That concludes the first quiz. Any questions about the questions and answers? Okay, in that case, let's go on to the second quiz, the one we just took a moment ago. An accounts payable by definition is a payable that a customer owes to a vendor. And the word customer is defined broadly. So for instance, you guys are customers to the university. A client that pays a CPA is technically legally a customer to the CPA. It's a customer to a vendor. Now, a security or a secured loan or the act of securitizing a loan all refers to collateral. Basically, the lender says, you don't pay me, I seize your property. You could argue that all of these actions do make a bank feel more secure in a way, but the word secure specifically in a business sense refers to collateral. Okay, I get 3 vacation days. I carry forward one. My employer owes me one. That day is worth $1. The liability is $1. Next up, for each of the last 2 questions, there is no revenue or expense. When I get the dollar from the customer, but I owe the customer $1, presuming that the customer returns the container, then cash goes up by $1. A liability goes up by $1. And if an asset and a liability both go up by the same amount, assets minus liabilities or value do not change. When Louis returns the container and Sasha repays the $1, then assets and liabilities are both going down by the same $1. Well, if assets and liabilities are both going down by the same amount, assets minus liabilities or value does not change. And once again, there is no revenue or expense. Okay, questions about this particular quiz? Questions about either one of these quizzes? Going once, going twice. And okay, as you can see, we are in the home stretch, very much so. And that concludes these 2 quizzes. Let me do this. Let me jump in and conclude the chapter. I think what you're going to find is everything in this chapter at this point forward, you've either learned, possibly as far back as principles of financial accounting, or if you have not learned it, it's just common sense. So either way, I don't think you're going to have huge problems with the material that we'll cover today. And then I'll just take a couple minutes at the end of class just to review, where we are, where we're going, because we still have a couple of moving parts, different things to keep in mind. But again, let's wrap up the chapter. I will share screen once again. Okay, we are back to sharing screen. The illustrations to wrap up the chapter are 1310 through 12. It's the ones that are written on my content notes. 1316 through 18. And then there's a couple of definitions to cover as well. Okay, so we're still talking about liabilities. 1310. Customer prepays for something. Okay. Netflix, for instance, Netflix charges us at the beginning of each month for a month of service. If a customer is going to prepay, when we get the $20 from the customer, we increase cash by 20. However, we have not provided the service yet. And even though legalities vary from state to state and product to product, the general business law says if you've paid someone and they have not delivered the service yet, under general law, unless you've agreed otherwise, you have the right to cancel the contract and get your money back. And so when you collect the cash, if you owe the money back, if the customer cancels the contract because you haven't earned it yet, you don't increase the value of your company. You increase a liability. And even though this is called deferred subscription revenue, don't let the word revenue fool you. Deferred revenue is actually a liability, which means at this moment, I haven't done anything to earn the money. If the customer cancels, I owe the customer 20. But time goes by and I start to earn the money by delivering the product or the service. And it looks like what's happening here is 1/4 of the subscription period has expired. Well, okay. That means that if 1/4 has expired, then 1/4 of my initial liability I won't have to repay if the customer cancels at this moment. So I reduce the liability by 1/4, or $5. And if a liability goes down, assets minus liabilities, or the value of the company, goes up. That is revenue, and that is real revenue, as opposed to deferred revenue, which is a liability. Questions about customer advances? Okay, on to 11. Gift cards. A gift card is actually an advance, because if you think about it, you buy a gift card in advance, and at the moment that you buy the gift card, you probably have not purchased anything with it yet, so you haven't used it. And so it is exactly the same journal entries as you see up here. Namely, when you first sell the card, debit cash or increase asset, credit liability, increase liability. As the card is used, as you earn the money, you no longer would have to pay it back should the customer cancel. And so as the card is used, you would decrease the liability, debit deferred revenue, and increase the value of the company, credit revenue. Now, the textbook author throws in just a little extra thought. What happens if the customer never uses the service, which means in this case the gift card expires? Well, at the moment that it expires, you will no longer have to repay the customer should the customer attempt to cancel. And so you eliminate the liability by debiting it. But once again, if a liability goes down, you increase the value of the company by crediting or increasing revenue. Any questions about number 11? Lawson, go right ahead.
Can you say again what you said about gift cards at the first part? I missed that.
Yeah, a gift card is basically exactly the same thing as a payment in advance for something like a subscription, meaning you're paying upfront, even though at the time that you're making the payment, you have not received any service yet. You have not received any value. Pay first, I will serve you later. That's true of subscriptions, usually, and that's true of gift cards as well. Okay, now 13-12. This is actually what I think of as a fairly simple concept. And once again, the textbook author just gives you a whole lot of information in a messy way, which makes it look a lot more difficult than it really is. This is what's happening. At the beginning of this problem, you have $12 million of debt, which is due within the year. So it's short term or current. You also have $4 million of debt that is due next year, which means $4 million is long term or non current. Well, the $4 million that was long term to begin with at the beginning of the problem is still long term in the solution. So that doesn't change. However, the $12 million that was short term, the company basically takes 7 of the 12, which is initially short term, and renegotiates it to make it long term. Well, if you have 12 million of debt that is short term or current, and if you take 7 of it and make it long term, then the remaining 5 of the 12 will still be short term or current, but 7 of the 12 will be reclassified as long term. And the reason why you know that 7 million has been reclassified as long term is because the author says or writes, you now have a line of credit, it's newly negotiated for 7 of the 12, and you could borrow it at any time, but it will mature in 2 years. And anything that's due in more than 1 year is long term. The concept is basically if you take any debt that's due within 1 year, and if you renegotiate it so that you won't have to pay it until more than 1 year from now, it is reclassified from current or short term to non-current or long term. That concludes 12. Any questions about 12? Any questions? Okay, so on to B and contingencies. A contingency is a liability which may or may not have to be paid. You're not sure. And in fact, the word contingent, I mean the English word, the normal use word, if something is contingent on something else happening, then if you're not sure if that something else will happen, you really don't know if the contingency will happen either. Okay, contingent liabilities are liabilities that we may or may not have to pay. We're just not quite sure. Okay. By the way, the most common contingent liability is a lawsuit. Someone sues you. Will you win the lawsuit? Will you lose the lawsuit? And if you do lose, how much will you have to pay? If you're not sure, then the lawsuit liability is contingent upon the outcome of the court case. Okay, so with that in mind, this is the table which I believe, on the one hand, you probably did not see before, but it's really just common sense. And I know it does not look like it's common sense, but bear with me on this. I think we'll agree that it's pretty straightforward once I explain it. So what's happening here is you have this liability. It's a contingent liability. You're not quite sure if you're going to have to pay it. Well, let's say that the likelihood that you'll have to pay anything is remote, meaning, yeah, in theory it could happen, but realistically, you're almost certain that it won't. Well, then you really don't have three different columns because each column says the same thing. Each column says, don't worry about it. No accounting is required. I mean, there are a lot of liabilities that you face every day where you say, yeah, I might have to pay that, but I can't imagine that I will. The probability or likelihood that I will have to pay that is remote. No disclosure, no journal entry, nothing required. Okay. What if, and actually let's go to the other extreme. Let's say you think to yourself, I'm probably going to have to pay something on this lawsuit. I will probably lose the lawsuit and then I'll probably have to pay something. Okay, then whether you know for absolute sure, absolute certainty, what you will have to pay when you lose the lawsuit, or even if you can just reasonably estimate what you'll have to pay, if you believe that you'll probably have to pay something and you can reasonably estimate what you'll have to pay, or if you know it outright, then liability accrued means you have to record the liability in your general ledger. Credit liability, debit lawsuit expense. And of course, once you do that, you do have to disclose what's going on in a footnote to the financial statements. Okay, there's two other points to make. First of all, I did skip over reasonably possible. What if you believe that you're not quite at the point where you think you'll probably have to pay something, but you think it's reasonably possible that you might? Okay, that's in between. And so what you do is a compromise between don't worry about it at all, remote, and record the journal entry and disclose what's going on, probable. For in between here, you do need to disclose what's going on so that the reader of your financial statements are not taken by surprise. But if you don't probably think that you're going to have to pay something, there is no need to record a journal entry. No liability accrued required. Okay, please keep something in mind. The known column here and the reasonably estimable column are literally the same column. Why? Because in my personal experience, no one ever knows anything for sure. Even if you are fairly certain, you usually say, but I don't know, like for certain that I'm going to have to pay this. And so you're usually in the reasonably estimable column. And I guess if there was ever a point where you absolutely positively knew for certain, known what the dollar amount is, then this would apply anyway. The other thing to keep in mind is the author does something strange right here in what I highlighted. What if you probably have to pay something? The likelihood of payment is probable. But what if you say, I have no idea what that amount will be? Well, usually what happens is the accountant is told, take your best guess. And that becomes the credit to liability and your debit to the expense. What the author seems to be happening here is the poor accountant starts crying, I don't know. I can't reasonably estimate it. I have no idea what the number is. And if I have no idea, I don't know what number to put into my journal entry. Well, on the one hand, I guess if you have no number to put into a journal entry, I guess you have to go with a disclosure note only. But I've never actually seen that happen. I've never seen a company willingly admit that it's so clueless about this liability that it probably will have to pay, that it cannot possibly reasonably estimate it. I mean, after all, if you were the company's chief financial officer, and if you knew that there was a significant liability that you would likely have to pay, would you want to admit that you do not find it reasonably possible to estimate what that liability might be? No. I mean, I guess it's theoretically possible that you might, but basically, even in such circumstances where it's difficult to reasonably estimate what the liability would be, companies do that anyway. Companies take their best shot. And so the bottom line here is if you do have a contingent liability, if you might pay something, but you're not sure how much, then if the likelihood that you'll have to pay something is remote, don't worry about it. Don't have to do anything. If you'll probably have to pay something, then you record the journal entry and you disclose what's going on. In the middle, if you think the likelihood of you paying off the liability is reasonably possible, then we have a squishy in between category, disclosure only, which accountants always, some agree with, some disagree with, but that's the nature of these in between categories. Very often, no one is truly happy with the compromise that occurs in between. Okay. If you have something that actually is known with absolute certainty, it's no different than if it's merely reasonably estimable, because pragmatically speaking, nothing is ever known with absolute certainty. And if you get to this one weird situation, the textbook author says, if you really should book a journal entry, but you have no idea what the number is, no way to estimate it, and you're not embarrassed to admit it, I guess the only thing you can do is disclosure note only, but I've never seen anyone willing to take that approach. Lawson, go right ahead.
What was the journal entries again? Was it to debit liability or was it to credit liability and debit lawsuit expense?
So you are recording the liability, and the problem is you're not quite sure what the number is, right? So you have to estimate what the number is. And so when you are recording a liability for the first time, you are increasing the liability, which would be a credit to the liability. If you increase the liability, then assets minus liabilities, which equals value, value is decreasing. And so that would be a debit to expense. Okay.
Thank you.
Sure, sure. Okay, next up, product warranty. I sell a product and I know a certain amount of product that I sell is going to malfunction, to break in the future. And because of my warranty, I'm going to have to spend money to repair it or even replace it if it's irreparable. Okay. When I first sell the product, I increase cash and I increase the value of the firm revenue because I'm selling the product. Even if no one has yet sent the product in and said, you need to repair it, it's broken. If I know that some of what I sold will have to be repaired, and that I will eventually have to pay $140,000 to repair it, that $140,000 that I'm going to have to pay is my liability. So I increase liability, which reduces the value of the company, and that is an expense. As my customers do contact me and say, you sold me a piece of garbage. It's broken now, and I want you to repair it. Okay, no problem. That's why I booked the liability. I knew that someone like you would be sending in your broken product that I sold you. So I credit or reduce cash to spend money to repair the broken product, but then I reduce the liability because I'm paying it off. Any questions about 1317? Yeah, in my opinion, it's just sort of variations on the same theme. And again, I think in one way or the other, you have been seeing these sometimes ever since principles of financial accounting. 1318 is just a little bit different. 1318 says, okay, um, I think my product warranty cost, what I will spend in the future to repair products that I just sold, is going to be anywhere from 50,000 to 60,000 to 70,000. But I'm not quite sure which of these three will be the exact amount I will spend to repair what I just sold. Well, if there's a 20% chance that my warranty cost will be 50, a 50% chance it'll be worth 60, and a 30% chance it'll be worth 70, then I have to book one of those things, one of those numbers as my liability. Which of these three numbers do I book as my liability? Well, I take the weighted average of those three numbers, which is 61. That is my liability. I'm not quite sure which of these three numbers will be my warranty liability. Then I take the weighted average of the three. Furthermore, what if the warranty is going to be, what if the money that I have to spend to repair a product under a warranty will happen so far in the future that I should really record as a liability the present value of what I spent as opposed to the absolute value? Because, if I sell you something and if I say, if it breaks tomorrow, return it to me and I'll fix it. If I fix it tomorrow, there is no present value concern. But if I sell you something and if I give you a 10-year warranty, and if it breaks in the 9th year that you own it, well, having to spend money to repair it 9 years from now, the present value of what I'm spending all the way out there is going to be a much lower number today. And so that's what's happening here technically. If the warranty cost will not be spent until the future, then the liability today is the present value of that cost. In this example, 58 as opposed to 61. Okay, questions. Okay, finally, definitions on this page. What we've been talking about is the technical phrase is loss contingency. I don't know if I'm going to suffer a loss in the future, then I should record as a liability today. I am uncertain about that. And so that's why this is a contingent liability or contingent loss. As we saw on the little table, if there is at least a reasonable possibility that the loss will occur, you do need to tell the financial statement reader about it. The only time that you don't even bother disclosing it is if the chance of liability is actually remote, which basically means most likely it's not going to happen. Most products that you buy are accompanied by a guarantee. I'm not quite sure that's correct. There's an awful lot of products that I buy, and somehow, some way, people, if they break, stores don't necessarily want to give me a refund. Not that they break often, but again, it would be nice if this was true. I'm not quite sure that's necessarily true. The cost of satisfying guarantees are recorded in the same period as the period of sale. That's exactly what we were doing. If I sell 10 products today and I record the revenue for selling 10 products today, if I'm pretty sure that one of those 10 is going to break, then I credit warranty liability, debit warranty expense for the present value of fixing that one item that will break, and I record the journal entry today. The contingent liability for quality assurance warranties is almost always accrued. Basically, what that means is unless the chances that your product will break down are remote. I mean, sometimes companies will say, my product is such high quality that the chance that it will break down and I will have to pay on a warranty is remote. And so I don't have to record anything and I don't need to disclose anything because my product is so high quality. That almost never happens. What almost always happens is you can expect at least some of your products to break down. And therefore, you can expect at least some of your customers to bring back their products for repairs. And therefore, you almost always have some recording of the liability. It is true that Financial Accounting Standard number 7, that the FASB promulgates, is the one that you look for in reading more about this information, about this requirement. And that is it. That concludes, there's one more. Sorry about that. It must be probable that an unasserted claim will be asserted before even considering whether or not the journal entry is recorded. Well, what they're trying to say is if you say to yourself, I don't, if there's someone out there that might sue me, but if you say, I don't think it's probable that that person will ever sue me. Why? Maybe they moved out of state. Maybe even if I caused some kind of loss, it's minimal. Maybe it's my mother, and my mother would not sue me no matter how bad the product I sold her. For whatever reason, if I think it is not probable at all that someone who might sue me will actually sue me, then there really is no liability to record. That's all that this is saying. And that, I believe, is indeed the final definition. And that concludes the chapter. Let me acknowledge I moved through that with a little greater speed than I do with other material, but that's only because I think for most of what I just reviewed, you already saw it in prior classes. I think the only thing that might be new is, let's see, hold on. I'll go back to it. I'll find it. The only thing that might be new, yes, it was here. Yes, the only thing that might be new is 13-16. And again, I think that's relatively commonsensible. And that, again, that's the only reason why I moved a little bit more quickly than I usually do. But now let me pause. Any questions about anything I covered today? I'm going once. I'm going twice. And okay, so just a couple of small reminders. First of all, easy reminder, what I just covered today in terms of liabilities, that's what will be on our hopefully perfectly normal quiz in a couple of days on Thursday. Now, on Thursday, we'll take our perfectly normal quiz on this material. Then we'll begin chapter 14, which is long-term liabilities. It's the last textbook chapter that we have not yet started. Then I will also complete in a somewhat light way chapter 18, and specifically parts B and C. And that's because, well, first of all, that was the equity chapter that we began with. We took a quiz on at the beginning of today. And also, I do have videos for parts B and C. So my presentation on Thursday, my review, will be calibrated to the assumption that you're also watching those videos. The videos are just as brief as the first video for part A that you've already seen. And if you go back to the handout for that chapter, you'll see I have links for all 3 videos of that chapter now in that handout. So the bottom line is we take a quiz on today's material on Thursday. We begin chapter